Have you ever wondered how a massive billion-dollar hedge fund actually keeps score? Well, today we're going to follow the money. We are going to track a single investment from the very moment it hits the fund's bank account all the way to the final profit calculation. We're going to see every single step. So let's dive right in.
Right, so how do they track every single dollar in a multi-million-dollar fund? We're going to answer that by basically cracking open their official diary, the accounting books. We're going to follow a dollar on its entire journey. And the language these books are written in, it's all about something called the journal entry. Just think of it like a single line item in that diary. Every time money moves, it gets an entry. It uses debits and credits to tell a little story. This is the fundamental building block for everything we're about to look at. Okay, so our story begins where every fund story begins, with capital. An investor decides to put their money in the fund, and from that moment, the accounting clock officially starts ticking. And we're starting with a pretty big number, $5 million. An investor subscribes this amount, and this is the chunk of capital we're going to follow through its entire life inside this fund. And here we go, our very first journal entry. The fund's bank account gets a $5 million debit. That just means its cash goes up. At the same time, partners' capital gets a credit, which represents that investor's ownership stake. Now, here's a really crucial detail. Even though $5 million just showed up, the fund's profit is still sitting at zero. This is not income, it's just swapping cash for a piece of the fund. Okay, so we've got cash in the bank. Now the fund manager's real job starts. They've got to put that capital to work. Let's see how that actually looks on the books. So, the fund buys $3 million worth of securities. Look at the journal entry here. The investments account is debited. That's a new asset on the books. And the bank account is credited because cash went out the door to pay for it. The main point here is that we've just swapped one asset, cash, for another asset, investments. And again, absolutely no impact on the fund's profit or loss. Not yet. All right, so now the fund is holding the investment, but the market doesn't just stand still, right? The value of those securities is going to change every single day. And the fund's books have to reflect that reality, even if nothing has been sold. This whole process has a name. It's called a mark-to-market adjustment, or just MTM for short. It's a really core principle in fund accounting. You don't wait until you sell to see if you've made money. You constantly update the value of your assets to whatever the market price is right now. So let's say our $3 million investment is now worth $3.2 million. Hey, that's a $200,000 gain. But remember, it's only on paper. To record it, we debit investments to increase its book value, and we credit something called unrealized gain. And here is the key moment. That gain hits the P&L, the profit and loss statement. For the very first time, our fund is officially profitable. And this brings us to a super important distinction. An unrealized gain is just a temporary change in value. It's profit that only exists on paper. A realized gain, on the other hand, is when you actually sell the investment and lock in that profit as cold, hard cash. Understanding this difference is absolutely vital if you want to understand a fund's performance. Okay, the waiting is over. The fund manager decides it's time to sell the investment, and maybe they collect some other income along the way. It's officially time to turn that paper profit into real profit. So the fund sells the security for $3.3 million. On the books, it's pretty simple. We record the cash coming in, we take the investment off our books, and most importantly, we book that $300,000 difference as a realized gain. That paper profit, it's now real, cash in the bank profit. But that's not the only way a fund can make money. Let's say it also got a $20,000 dividend. This is much more straightforward. Cash comes in, so we debit the bank, and we credit dividend income, which, you guessed it, flows directly to the profit and loss statement, immediately boosting the fund's bottom line. Of course, running a hedge fund isn't free. There are fees to pay the managers, other costs to cover, and these expenses also have to be recorded. And yeah, they directly reduce the fund's profit. Here we've got a $50,000 management fee. This gets recorded as an expense, which immediately lowers our profit. On the other side of the entry, we credit a liability called accrued expenses. Now, don't let the jargon fool you. That's just accounting speak for an IOU. It means the fund owes the money, even if the cash hasn't actually left the bank yet. And then, of course, there's the performance fee. That's the manager's share of the profits. In our case, it's $100,000. Just like the management fee, it's debited as an expense on the P&L and it's credited as a payable, another IOU the fund has. You can see how these fees are a pretty big cost that directly impacts what an investor gets back. Okay, so we've seen money come in, we've seen it get invested, we've seen it generate gains, and we've seen it rack up expenses. Now, it's the moment of truth, putting it all together to calculate the fund's total worth, its net asset value, or NAV. So, after all of that activity, the gains, the dividend income, minus those pretty hefty management and performance fees, what's the bottom line? The fund's total net income is $370,000. This single number is the ultimate measure of how it performed over this period. So what do we do with this profit? This is where the closing entry comes in, and it is so important. We basically close the profit and loss account. We debit it for the full amount, which resets it back to zero for the next period, and then that profit is credited directly to the capital account, which increases the total value of the fund. This is how performance literally translates into value for the investors.
And finally, our money's journey has come full circle. An investor decides to redeem or take out $1 million. This is essentially the exact reverse of that first entry we saw. Partners' capital is debited, which reduces their stake, and the fund's bank account is credited as the cash flows out.
Okay, we have seen a lot of transactions fly by. But let's stop and ask, which ones actually made the fund more or less profitable? Which ones were the ones that truly moved the needle on performance?
This summary table makes it all crystal clear. Just look at what doesn't impact profit. Investors putting money in, taking money out, or the fund just buying an asset. The events that do move the needle are the on-paper value changes, the real cash gains from sales, income like dividends, and of course, the fees. This is the absolute core of what drives a fund's reported performance.
So, we've followed the money from start to finish. We've seen exactly how every dollar is tracked and how profit is officially calculated. Now that you know precisely how the score is kept, how does this change your view on a fund's performance? What does it tell you about the real risks and rewards hiding behind the numbers?